All right, it is time for the Friday Market Meetup panel. It might have been a few days of vacation sprinkled throughout this week, but no shortage of news flow. We're going to wrap some of the big topics this morning with our guests. I want to welcome in Stephanie Lewicky, Senior Manager of Futures and Forex at TD Ameritrade, Scott Connor, Director of Education, and guess who else we got? On the big boy, Bob Iaccino, not leaving his post at the CME, but joining us. What's going on, Bob?
How are you guys?
All right, we're doing well, Mr. Iaccino, founder, chief strategist at Path Trading Partners. So, Bob, get us started here. The trade wars now apparently are on, $34 billion. Should we be concerned, or is it the same situation that we've been expecting?
You know, I would get started on being concerned. I don't know how much of this is priced in, and I think that's the issue. Obviously, the $34 billion was priced in. We're not getting crushed here in the equities today. NASDAQ a little higher just before I came on. I don't know where it is now. The thing that concerns me is the escalation of this, and I think that's a little bit of theater of the obvious, but when President Trump spelled out all the steps and China immediately retaliated, or at least announced retaliation as they did overnight, I think you start to get a little concerned that China isn't going to blink, and I don't think President Trump's going to blink either, especially when you get a Goldilocks non-farm payrolls like you did today. Still, things still look pretty good in the U.S. economy, and that provides a little bit of cover fire to sort of continue on this path. It bothers me a little bit at this point.
I'm glad that Bob brings this up, guys, because that cover fire there, I think, is important as we look to see just how this has affected markets, right? We just did a whole hit at the Direxion with Sylvia Jablonski about their leveraged funds, and people are piling into these 3 times China bear levered ETFs, piling into levered small caps. There's starting to be a sort of market developing around this entire trade story. It's now people are pretty exposed to a lot of these items, Stephanie.
They are exposed to them, and I think as we think about earnings season that's coming up starting next week, I'm anxiously awaiting to see what the CEOs might say on their conference calls, and if they're going to start saying, hey, well, the trade war will have this type of impact on us. But yes, it's not just, I mean, we do have a great story here in the U.S., you know, strong economy, strong fiscal economy with the tax cuts, but now, you know, that's all being hindered really by these trade concerns.
Scott, if we start hearing this from CEOs and it drops the expectations, does the concern about the high Caterpillar watermark then take on even new life, and we don't have that fundamental support that we've been able to count on for so long?
It might, absolutely it might. But I think investors are looking at the big picture, Oliver, and that they see that, you know, the China market, for example, is almost down 21% from the highs, right? So in other words, what's the degree of discount that's already in the marketplace for what might come? Okay, that's what's important to investors. And I think they recognize that maybe this isn't the level to flight. This is maybe the level to start, you know, making small investments if you believe that we're at or near a bottom.
So, Bob, did all the shakiness from these trade expectations already hit our markets? Is that why we see a lack of a sell-off this morning?
Well, yeah, I think this $34 billion was priced in. There was no indication that there was going to be any movement on the side of the U.S. administration. You know, it's interesting. There's a couple of things that pop into my mind right away, and some of them being cultural, having dealt with the Chinese before in the past. You've got people advising President Xi Jinping on the way to handle this particular trade war, and they don't want their voices to be quieted by failure in this, so they're going to kind of dig in. Now that this $34 billion is in place, in 2 weeks we get another $16 billion. I fully expect that's going to be implemented now, and I fully expect the Chinese are going to announce that retaliation. Then what? Then do the voices in China kind of get diminished? I mean, if their plan doesn't work, if they back down, they get pushed aside, and that's the way that government works. And then you've got other issues where I think Oliver, you, me, and Stephanie and Scott are the only ones on the planet talking about Canadian crude oil and what happens with that. There's actually an effect with the trade wars there, as some of this Chinese steel that was getting dumped in the U.S. now gets pushed to other markets. So Canada now has cheaper steel coming from China. They just approved a pipeline to the Pacific, not down to the Gulf Coast. So this changes the whole trade dynamic the longer it goes. We've had situations in the past where CEOs have said, well, we're not going to price in tax cuts. We don't know where they're going to come in. We're just going to continue to plan. This, I think, is a little different the longer it drags on and tends to Stephanie's point, maybe discount good earnings as they come out a little bit.
Guys, real quick before we go to break here, Bob, I think within that observation is also bring up something that is, there's going to be ripple effects that are basically impossible to know at this point if things continue to escalate, because 200 billion of tariffs, if we get to that point that the president said, China's not just going to, it may not just be about pushing back. It may be about trying to generate income in ways, because at a certain point they can't match roughly after 100 billion. So then does it go to these different markets? Does it show up there? And then you got to wonder, are people going to be in for a rude awakening if they're in some of these, big positions that are betting on essentially a quiet outcome? I mean, is there a risk then getting baked in the market? What do you guys think?
I think so. I think going back to Bob's first point about they're coming to the table, China and the U.S., and they're both sticking to their initial what did I say, tariff negotiations, right? So we're coming to the table with 34 billion. Everyone expected that. China's coming with the tit for tat, or tat for whatever it is, complement to that. So now that's on the table. Now I think we can proceed. But here's what's interesting. You're right. If you start breaking down, it's going to take time to see exactly how this plays out for the different corporations.
Right.
I thought it was really interesting seeing from Ford today how they came out and said, with their sales being down in China, and again, this has to do with models and things like that, but they are going to absorb the tariffs and not pass those prices on initially.
Right. As Harley Davidson said as well, they said, look, we're just going to have to eat it, basically.
Right, so to start. So I think it's going to take time for us to see how that plays out when you get down to the actual different sectors and companies within those sectors.
Yeah, Stephanie, last point.
And I think what you saw on Tuesday, the shortened market day, shortened market trading day, the news with Micron came out and said that China wasn't going to allow Micron to do business in China, so you had a big sell-off. But I think once you read below the headlines, Micron said they're not that exposed to China and they'll be able to move revenue around and it won't hit that much. So I think you get those initial headlines and then companies, they digest, and not to say that's the end-all be-all. We'll have to see when Micron reports earnings and look ahead to 2019 as well when we see if these have some real impact.
All right, guys, we're going to take a short break. Bob Iaccino, we're going to be back with you in just a moment. Stick with us as we talk about today's number from the economy, an important one in the employment situation report. Why are stocks rallying on it? Why are bonds getting bought? Are things weakening here relative to the rest of the world? We'll be right back as we discuss that in the context of an earnings season that's about to kick off. Welcome back to the Market Meetup panel. I'm Oliver Renick. We are joined here in studio by Stephanie Lewicky and Scott Connor of TD Ameritrade. But we've also got Mr. Bob Iaccino, the founder and chief strategist at Path Trading Partners, joining us from the Chicago Mercantile Exchange. Bob, thanks for sticking with us on this Friday. So the number this morning, is it good enough? Is it enough cover fire, as you put it in our last block, for what's happening on the trade front? Or are things starting to look more shaky on home soil here?
No, I think this was a great jobs number overall. Still like to see a little bit more wage growth. You saw the 210 spread go out about a basis point and then come back in pretty quickly. I like the number overall for job growth because it's consistent with what's been happening with wage growth, which we hadn't seen for a while. The wage growth came in a little bit less than expected, but it's still 2.7% year over year. We're not seeing much on the way of productivity growth. We did see just a blow-up manufacturing number, 19,000 last month, 15,000 expected. We got 30,000 plus added to the manufacturing payrolls. That's a positive for President Trump in his quest to kind of hold his hardline position in the face of trade. You got the labor force participation rate up quite a bit, 600,000 people going back into the labor force. So that's cover for the 4% unemployment rate and the 0.2% rise in the U6 as well. So overall, the number's pretty good. There's a slight amount of weakness because you didn't see hourly work week increase and you didn't see wages go up as much as the Fed would probably like to see based on their forecast. But I like the number overall. I don't think it shows a whole lot of weakness at all.
All right, so Bob, as he usually does, giving us a sophisticated interpretation, one could say. Stephanie, a less sophisticated version I'll throw out there is now stock investors are back to the bad is good or not great is good or some variation, a 2018 version of bad is good, where it's not perfect, so markets rally as rates stay low.
Bob did give a very sophisticated overview of the employment situation. So my take is, right, as I was gonna, if we look ahead to earnings, as I mentioned with the trade tariff talks, it did start out Q1 earnings season where we had really good earnings and the market was selling off. And now as I look at this was a pretty good number overall. Like Bob said, the wage growth was not quite there, was a little bit softer, but participation rate was really good. And now the market's up. I mean, we were this morning, slightly down, and the market's looking at this like it's a solid number. So
does the read here? Here's what we're looking at for the big banks next week, who are going to be impacted by interest rates, of course. And Scott, interest rates are lower this morning. So I guess one could look at this reaction and say, all right, it was a mixed number, but is every investor as sophisticated as the explanation we just got, or are they just looking at the 10-year, seeing it lower and saying, you know what, buy equities, I've seen this story before and I'm used to it and I'm comfortable with it?
Right. I think Bob did a great job of breaking down. This is an important number, probably one of the most important numbers that people watch on a monthly basis, but you need to break it down and look at it by sectors. Where are those numbers coming from? And at the same time, when you look at the unemployment rate moving up to 4.0, you think, uh-oh, that might not be so great. But again, if you break it down, a lot of that is sort of a temporary number coming from education and teachers being out of the workforce, et cetera, et cetera. So again, overall, good number, and I think you're absolutely right. I think investors are looking at that as saying, okay, positive for the market, but not too strong. In other words, the market's not overheating, not giving the Fed the impetus to raise rates more quickly and be hawkish. So it's kind of a Goldilocks type of scenario. Good enough, but not a lot of fear of inflation running away or wages pushing inflation. So good number overall. And of course, we're seeing that. We're seeing the interest rates come down, 10 years dropped, US dollars dropped. So I think basically the interpretation from the markets is that good number overall.
Bob, is the market basically making another big bet that inflation is not the concern that it was in February? Are we still, how many times are we going to come into this number saying, hey, yields are ready to pop, but maybe one day they actually will if we get a solid wages beat? We spent this morning talking about the percent of the unemployed that are coming from folks leaving their jobs voluntarily and how it's basically creating a gap where wages are supposed to catch up. So if that day comes, Bob, and people are buying bonds and buying utilities and stuff, is this trade going to just blow up in people's faces?
Well, yeah, it would, given that circumstance. But again, what I think I felt in the markets this morning when this jobs number came out, to take it down to just a base level, was a sigh of relief. Because what you don't want, given the trade backdrop, given the backdrop of tariffs and the acceleration of said tariffs, you don't want a reason for the Fed to go from 3 to 4 or 4 to 5 or even bump up their 2019 expectations, because right now what we have in the U.S. is a situation where confidence continues to increase. Volatility spikes have not been enough to hit that confidence, and that goes to the point you made about people saying, you know what, I'm going to leave this job and I'm going to hang out a little because there's jobs there, especially for skilled labor. So I think that's what this jobs number gave the market, was sort of a sigh of relief. Yeah, we're still good, but we're not crazy on the inflation front. There's that, and I'm sure you guys have talked about this ad nauseum, but there's that structural pressure on inflation, but we're not seeing productivity. So it's really interesting that fewer workers are doing more with more. Did I say that right?
I think that sounds
right. The productivity
right.
is not there given the technological advances. We're not producing more because aggregate demand isn't there yet. So that's kind of what's keeping inflation in check.
All right, let's bring this over to the corporate conversation. Next week, guys, let's take a little bit of a look ahead. Stephanie, you mentioned next week's earnings. I mean, one of the places where we first started to see these price concerns show up was, of course, last earnings season, where a lot of these transport companies talked about costs, staples companies talked about the transport costs, et cetera.
Mm-hmm. That's right. And we start with JP Morgan and Citibank and Wells Fargo next Friday, the big banks. And we also have, I think you have it up on the screen there, Pepsi and Delta will report next week. So it will be interesting to see if Delta comes out and as well as Pepsi, and if they say anything with, in terms of transportation costs, in terms of the higher crude oil prices, in terms of, like we said, the trade tariffs, if they are going to impact, I don't believe they're probably impacting the bottom line yet, but if they're going to, and if we're going to have, again, that good news, kind of bad news scenario that we had when Q1 earnings season started.
It's an interesting setup because there was a lot of volatility during the reporting season of Q1, Scott, and as a result, for the first time in a very long time, stocks, the S&P was actually net lower during the main chunk of reporting, which didn't happen basically for 4.5 years. Now we go into this reporting season with a little bit more strength in the market, a little bit more resilience. How are we setting up? I mean, what do we expect in terms of volatility?
Well, we could get the volatility, but again, going into this first week is very important. You just mentioned the banks will be sort of shooting off or starting off the week, but towards Friday we'll hear a lot from them. And of course, there's a lot of anticipation from what is happening with financials, because we've seen that sector come under pressure, and we're not seeing the jump in interest rates that they would like to see.
Yes, Scott, it was down 13 days in a row, right? The
exactly.
XLF. Yeah.
So I think investors are going to be watching carefully. But also, I think you hit a good point, Oliver, is when you said, what else are people looking for? Well, when Delta comes out, this could be a key earnings report as well, because now we're looking to see what effect has higher oil prices going to be on some of these companies in the transport sector. And Delta's the first one to kick that off. And let's see what they can do in terms of how that's affecting the bottom line.
All right, Bob Iaccino, give us your rundown. Next week, what's the most important thing as we kick off this earnings season?
I want to see if Delta was able to hedge their fuel costs any better than they have in the past. And I obviously want to see the banks. I mean, the banks, to me, given what they did with the stress tests and given how the Fed came out with mostly flying colors on all of them, I have an idea that they sort of got a glimpse at what the earnings were going to be. I know it's not technically part of the stress test, but I expect the banks to beat pretty good, pretty handily. And then I want to see how much trade tariffs is overhanging good earnings. I think earnings are going to do really well this season. But do they start to use it already, as Stephanie mentioned in the conference calls, saying we're guiding a little lower because of trade concerns? It's the weather of 2018. We saw that plenty of times where companies use weather as an excuse for what's going on in the future. That's really what I'm focused on in this earnings season.
Yeah. All right, Bob Iaccino, great to have you joining us this morning. Appreciate it, Bob. Enjoy your weekend. We'll see you next week. Sir Bob Iaccino, founder and chief strategist of Path Trading Partners, as well as Stephanie Lewicky, senior manager of Futures and Forex, and Scott Connor, director of education.